I think Anand spelled out the issue here at hand, the main issue, which is that equity has grown massively in the mutual fund AUM, in the mutual fund industry. Debt has not. And the tax change in the last budget has made things a lot worse for the debt side of the mutual fund industry. But behind every dark cloud, there are always silver lining. There's always silver lining. And that's what we will discuss today. So first, let me get some views on from Vinita and then Sandeep, so the non-mutual fund CEOs, on what it was like. I mean, you talk to a lot of retail investors, you conduct programs, education programs, especially for women. And you would have set some principles about when to invest in debt funds, when to invest in equity funds. Suddenly, when the tax changes, how do you deal with it? Like, the best laid plans of mice and men come to naught, right? So how do you deal with it?
I think the first thought is always take a pause, understand what the changes are, and not panic, because the first thing that we tell all the investors, because they're very small time investors, so whether any type of a change, what kind of an impact, we all need time to understand what the changes mean. So first thing is always that, and then of course then you try and come up with solutions. You tell them, like, whatever you have, like, pause, understand why you got into the debt fund initially, and if there is, still the silver lining, as we call it, that, there is still some positives about the debt fund and we should not be panicking, and continue with the positives, explain to them that there are ways out, and the tax system will always change. So, you cannot deny that 1 year to the next year. So it cannot be based on the tax rules that come up with, but you continue more with your goal settings and things like that.
Yeah, so if you remember, I mean, equity also has had so many changes over the years. We went from a system of no tax, no long-term capital gains, to the 10% that we have today, and we don't know what will happen in the future. So Sandeep, same question. How did once you make plans, you tell people, and suddenly the tax changes?
So Neil, let's put things in context first, right? We've analyzed over 90,000 portfolios. Typically in the smaller portfolios, and I call smaller as being 20 lakhs and below, we've seen over 90% allocation being in equity instruments, right? So, but if you look at larger portfolios, which is sizes over that, that's where we see an allocation to this asset, which is the debt funds. And those are therefore the portfolios that got impacted. The smaller portfolios, I think when you're building a portfolio, first you'll allocate to PFs and FDs and then eventually equity mutual funds, right? Whereas on the larger portfolios, there was definitely impact. In the month of March, we saw tremendous inflows happen in the fixed income category because everyone was trying to lock in the yields, one, but two, get benefit of the grandfathering that the tax regime was offering as of 31st of March. Post that, we have seen a significant cool-off from affluent and affluent plus investors in this category. The concern that we have is twofold. First is because of this, incremental allocation has gone more towards the equity side. And that sort of explains the fact that fixed income mutual funds haven't grown. The second is actually more concerning, which is allocation going to other instruments which are of the nature of fixed income, right? Which is in the category of direct bonds or even P2P lending, lease financing and so on, right? So MLDs. We see across the board an increase in risk profile in portfolios right now.
Yeah, so typically when the government closes one door, they forget to also close the windows. So you have this strange situation where if you invest in a debt fund, then regardless of your holding period, you will be taxed at slab rate. Whereas if you directly hold a bond, after 1 year, you're taxed at 10%. And that's actually shifting people towards more risk, especially for small investors, because they might be buying maybe 1 or 2 bonds or a small portfolio. It will never match the sheer diversified nature of a debt mutual fund. So now let me come to the MF CEOs. Neil, if I can start with you. PPFAS just yesterday filed for an arbitrage fund. So I think that is your solution number one. But if you can elaborate on arbitrage funds and how you will manage yours.
Yeah, so first thing is there are two certainties in life, which is death and taxation. So we have to live with it. We've lived with it over so many years that there are going to be tax changes. We are transforming as an industry, so we will see more level playing field and taxation changes. So we need to be ready for that. Yeah, so one thing is that for people why we launched the arbitrage fund is that, or we've applied for the arbitrage fund is that for the people in the higher tax bracket, if they want liquid fund-like return or they need money for less than 1 year, then arbitrage fund works good for them, you know. So that was kind of a demand also from our investors that have an arbitrage fund for people in the higher tax bracket. So that's that. Also going forward, so one thing is that in the debt mutual fund, the AUM, at least 75% of the AUM is held by corporates, which is less than 3-year money. So it's not too much is changing in that front, you know. There are people obviously will, and again, there's grandfathering. So if you have your asset allocation right, then there's not much to really do. Going forward, incremental money will obviously change from probably pure debt funds to probably a hybrid structure. So I think that's going to be something that fund houses like us who don't like launching too many funds will be forced to launch funds where there's 35 to 65% equity, so we can get the tax benefits, you know, the indexation benefits. So I think going forward, you will see probably a lot of fund houses getting into this space and launching either hybrids or multi-assets, so funds. So I think that's probably going to be the future.
So Neil, just to stay with you on this arbitrage point, how close a substitute is an arbitrage fund to a liquid fund? I mean, there are other factors that affect an arbitrage fund also, like the amount of bullishness in the market when the spreads rise or they compress. So what are the risks that investors should be aware of if they are thinking of arbitrage as an alternative?
So arbitrage fund is usually for a shorter duration, you know, so it's not for a very long duration. So on a shorter duration, it really doesn't really affect you that much. So it's not like liquid funds, but yeah, on an average, you'll get something like liquid funds. So, and you get the tax benefits of that too, because you're getting taxed at the equity taxation, not at the debt taxation. So net, I think it comes to around the same thing. It's not, it's probably maybe slightly better than liquid funds, if you're on the higher tax bracket.
So Aashish, again coming to your solution, I think WhiteOak has already a hybrid fund which has a multi-asset fund, I believe. Could you elaborate on that? And is that a solution to the debt fund tax?
Yeah, sure. So Neil, you know, just like we did create a multi-asset fund, and frankly, we filed it and we created it before the tax change. It's just that we were about to launch it, and in between in March, the taxation changed. So that's just a coincidence. In fact, we never created a product thinking about the tax structure, because if you really ask me, I genuinely believe that as the financial literacy improves, as we move to more a middle-class society, successively, I think tax breaks would go out. You know, because a tax break is a nudge for you as a saver or investor. It's a nudge for you to do the right thing. And if you actually look at it closely, say look at Section 80C, for instance, there's a wide array of investments for which tax breaks are given, which means that they just want you to do the right thing. They're not like trying to incentivize any one instrument over the other. It's maybe, you know, sometimes it's just the quirks of the process that some instruments become attractive and less attractive and those kinds of things. But I think over the long period, what we should guide investors is that get over this whole taxation thing and don't use taxation as your main criteria. I think that's a caveat or a disclaimer I would put first. But moving on to what you asked me, see, in our industry itself, multi-asset, multi-asset as a term is a generic term, right? Because what does the regulation say? The regulation says that when you have at least 3 asset classes with at least 10% each, that's called multi-asset. Which means that just like chemistry, you can mix up any number of asset classes in any number of combinations, and it will give you a unique risk return profile for the series of returns. So from our standpoint, what we realized is that, again, our industry is using equity taxation as the threshold for defining what the asset allocation should be. So that's where it all goes wrong, because the moment you say that equity taxation is the threshold for this fund, the defining criteria means it will start with 70% equity. And that's where the concept of multi-asset goes out of the window, because that's where it stops working, So you see a lot of multi-asset presentations which show you a lot of fancy charts about correlation between debt and equity. Those correlations work if you're talking 1 unit of equity with 1 unit of debt, then the correlation data is useful. But the moment you have 7 units of equity and 1 unit of debt, the correlation data is not going to work, right? So that's why we started creating it ground up. Our threshold criteria was that if somebody holds this for 3 years, the standard deviation of rolling returns should appear like a bond fund. And then the return is an outcome, because you control for volatility. See, if I'm looking for a debt substitute, the first thing I should do is control for volatility and then accept whatever return comes out of it as a outcome. And the other important point is that if you want multi-asset to function like multi-asset, where all these correlations of asset classes work, then you should have unfettered, equitable allocation across asset classes. So the way we have devised it is, like equity is 20-30%, global equity is about 10%, gold is unfettered. I mean, on an average, we end up owning 20-25% gold, and then the rest is fixed income. So I think we didn't create it with tax in mind, yeah.
Just to understand this, you haven't even said that equity has to be minimum 35%, because that would put you in the old regime of 20% tax with indexation.
So now, obviously, look, in the best interest of the investors of the fund, since my allocation allows me, it only makes sense that I hold 36% and then calibrate it where the model is telling me to calibrate it. But at least it's not like putting 70% and then calibrating it all the way down to 30% with some 40% in arbitrage. For a multi-asset fund, to do 35-40% arbitrage is suboptimal. So I think at least this works out better, that we hold 36% equity, go for hybrid taxation, and then the calibration is just few percentage points. It's not like half the fund is calibrated down to, reduce equity.
Okay. So Neil, coming back to your conservative hybrid fund, are you thinking of changing the category?
Yeah, so that's a great question. So we run a conservative hybrid fund, which holds, and the definition of conservative hybrid is that you cannot hold more than 25% equity. So even if you hold it for more than 3 years, you're going to be taxed at the full rate, So obviously, one of the things that we've been thinking about is how do we, so again, in the conservative hybrid fund, we have 3 asset classes, similar to like a multi-asset where REITs is one of our asset class, which is 10%. Equity is about 15%, and the rest 75% is in debt. And that we thought was a really good kind of allocation to have, and we didn't want to change too much to that. So one thing we need to do is just make the equity 36%, right? I mean, that's what we need to do. So we were wondering which is the best way to go about it. And multi-asset is something we thought would actually be really good for this kind of an allocation. Unfortunately, in the multi-asset, when we went to look at it, is that they don't allow REITs as an asset class. So we have, as we speak, we've given our representation to Sebi, as well as a representation from Amphi has gone to Sebi to allow REITs and InvITs as an asset class in multi-assets. So we are just waiting on that. I mean, if we had that clarity, we would have probably done it by now.
Sorry, just to understand this better. So it's zero REITs and InvITs in multi-asset.
So the definition of a multi-asset, like Aashish said, is that minimum 10% in each asset class, or at least 3 asset class. So that's the multi-asset definition. But the definition of REIT is that you cannot hold more than 10% REITs in a single scheme. So one is saying minimum, one is saying maximum. So we are trying to get the clarity that can we, in the multi-asset, can this be minimum 10, I mean, can it go above 10%? So that's where the clarity needs to come in. Right.
So because you want to put more than 10%, but if you're okay with less than 10, you could launch.
I can't, because I can't launch the multi-asset if the REITs and InvITs is the definition is maximum 10%. So I have to go a little above 10%.
Right.
For a multi-asset.
Right. So I think this is a broader lacuna actually. This 10% cap is on REITs. Has stopped REITs from growing much in the MF industry, and in general there are only 3-4 listed REITs. In fact, one exception to all of this is an index fund tracking the REIT index. Have either of you thought about this?
No, I mean, we are pretty much happy being active managers, so stick to that.
Aashish?
No, I think you're saying an index fund of domestic REITs. I mean, it would be a good concept. I mean, provided, haven't thought about it, no plans to launch, but I think it's a good concept. You know, because see, all said and done, mutual fund investors prefer a mutual fund vehicle. Yeah, because you know, you can click a button, buy $500, matter ends there. But to access REITs, otherwise you need a broking account and you know, so many other things. So I'm quite sure that it will take off as a product. I think somebody needs to think about it. And there is merit. The other important point is obviously the depth. I mean, how many instruments are available, you know, because all said and done, you can't just blindly bung in some money into some REITs. You need analysis on that, you know, in terms of, it needs fundamental analysis. But I do concur with what Neil said. You know, I think from a regulation perspective, we need to be clear that REITs and InvITs are a very good hybrid instrument. It's yield-based, but it has price action also, right? So it's a very good hybrid instrument. So I think we need to figure out how it can form a substantial part of any hybrid mutual fund, whether it is multi-asset or balanced or whatever. I mean, it needs a space to be allocated and slotted appropriately. I think that's needed.
Yeah, and let me just add a point on tax. So again, the same budget suddenly complicated life for those who directly hold REITs, because it said that, so REITs pay out money in various forms, dividends, capital gains, and of course something called return of capital, which earlier was exempt, but now there is a very complicated system where you have to calculate how much has been already returned against the face value of the REIT and then figure out your tax, which has made essentially holding directly REITs really, really complex, right?
But Neil, I'll just add to that, right? A lot of our bias comes from the anchoring that we have to the previous tax regime, right? But if you think about REITs, if you think about bonds, like to like, that asset is better held via a mutual fund than via a direct instrument, right? Aside from the fact that there is diversification, there is better diligence, there is a fund management team evaluating and identifying and creating that portfolio, the fact is that in mutual funds you get tax deferment, and that adds value, right? Imagine you're holding a bond or a REIT instrument individually in your own demat account. You get those cash flows, you have to pay taxes, advance taxes and so on it. Whereas if that asset is held via a mutual fund, it's significantly more efficient because I have more money to compound that over a period of time. So everything being equal, if you have an 8% bond and a mutual fund tracking 8%, over a period of 3 years, you'll have almost 5% incremental return just because of this tax deferment structure that mutual funds offer.
Yeah, so let me come to some solutions that exist now, tax efficient solutions. So both Vinita and Sandeep, is NPS a good option? Are there other products other than mutual funds that you can use for direct bond investment?
So I would say before even reaching to NPS, we are all like, you know, even the salaried class, they have the EPF. Then you have the PPF also, which goes on. There are other tax saving products which are already there. Then of course NPS with that 50,000 more per annum is a very, very attractive thing. The only drawback that I feel is that, having that 60% which is tax free that you get as a lump sum and then that 40%. But it has definitely become a very attractive product now that, it is equity linked and people are getting good returns. So again, I feel NPS is still in a stage where they are clarifying products and the guidelines. It is being, when we go to the corporates, it is shown that most of the employees are into that. So it is definitely an alternate.
Neil, again, if you think about it, what is the customer telling us, right? Incremental money is continuing to get allocated to corporate bonds. We've seen Sebi come out with OBPP regulations around this to enable this market. But at the same time, we're seeing money go into lease financing. We're seeing money go into P2P. We've also seen the size of credit AIFs increase dramatically, right? And there are obviously challenges with that, given that you can only put in a minimum of 1 crore. And therefore, there's only so many AIFs that you can deploy capital in. what is the customer really asking for? I think post 2018, the NBFC crisis, we had a situation where we today don't have enough funds investing in true corporate paper, right? And it's not about the tax, it's about...
Sorry, when you say true, do you mean high yield or?
High yield, well diligenced, well researched, and mutual funds are best placed to do this analysis, right? They have the research teams, they're already deploying that on the equity side. They can extend that to the fixed income side and be able to create portfolios which have higher accruals. And honestly, customers will be willing to pay the tax if the risk return profile is attractive. Obviously, there are things like asset liability mismatches and learnings from the previous era that we have to deal with. But I think there is a massive opportunity in that category, and I guess we need to look forward to those mutual funds coming up with those kind of opportunities for us.
Aashish, your take on this. Why aren't credit risk funds taking credit risk?
Yeah, I think, see, it's like this. The learning is that it's best done in a close-ended, gated structure. See, even when the mutual fund episode happened in 2020, the moment the fund was gated and held on, money came back, right? That's what I mean, of course, there must have been some NPA and all happened, but the moment it was gated. So it's the one lesson is that sometimes you have to give up liquidity to preserve capital. That is one lesson out of that whole thing. That is the reason why the action has moved to AIFs, which are say 5 years, close-ended. Communication is not mass retail. Communication is limited to people who supposedly understand the risks. So I think that's the reason why it has moved there. The other important thing is that if you want to do it in a mutual fund, then you need to enable hard lockups, or you need to enable steep exit loads, or you need to figure out some other ways to do it. But that's not permitted. It's not going to work. Right?
But Aashish, you have closed-ended funds which you can launch today and take credit risk in them.
So if you really ask me, close-ended funds as a category for a variety of reasons is, not preferred. Like for example, one of the reasons is that close-ended funds, if I'm not wrong, there is a cap of 125 basis points. You cannot have more than 125 basis points operating expense in a close-ended fund. And I don't know if it is only equity or equity and debt, but I'm quite sure that the cap is 125 bips. If I'm not wrong, debt might be lower actually. Okay. So I think there is that challenge also. And the other important thing is that when it comes to retail mutual funds, one of the key features of a retail mutual fund is that the liquidity it gives. So if I'm going to say that, yeah, okay, this can potentially give you 150 or 100 basis points more, but forget about your money for 5 years, then that's the other angle which comes in. Right? But I think the long and short of it is that you should not do it in something which gives 24-hour liquidity. Because, every once in 5-7 years, some accident tends to happen.
Sandeep, can you talk about what's happening with HNIs? What are the new exotic products that are now entering the market given this debt fund tax?
So like I said, HNIs will primarily deploy capital into regulated assets, and the credit funds or the credit AIFs have scaled dramatically. We've seen like over the last 6 to 8 months, significant capital or commitments flow into this asset class. There's obviously concern among HNIs that is there enough high quality deal flow to be able to absorb this kind of liquidity, and what will that mean for the kind of yields that get locked in on these kind of assets, right? So if a lot of money is chasing a few high quality deals, then and the yields go down, is that then attractive enough from a risk return profile? So I think that is the challenge, but having said which, a lot of money has gone into individual bonds. Mint wrote about it today in some individual instruments which have sort of caught the fancy of the market. I think there is, and they are willing to, by the way, lock in capital also. So to that extent, if there were gated products where there is ability to put that money aside, I think allocators like us will be willing to take it to the market.
Fair enough. But apart from AIFs, so AIFs is one. Are MLDs over because of the tax? Are there, you talk about invoice discounting, and all of this is, a lot of this is unregulated, right? So invoice discounting, etc. What is the future for India's investors in debt?
Look, see, again, MLDs by themselves are not bad instruments, right? They are instruments which give you some sort of fixed income nature with equity upside. So in themselves, there is nothing wrong with MLDs. The question, however, is how do folks like us take it to the market? Are we communicating things correctly, and are we educating the customer before they invest into that asset? So I think that therein lies the responsibility. We need to tell customers about the fact that there is credit risk that they are taking in these kind of assets, that the fact that, again, liquidity is not easily available. I think there is space for these kind of structured products in the regulated domain, provided we back that up with education.
Vinita, is small savings an option for, especially for retail investors? Will they make a comeback?
Sorry.
Small savings, like you had mentioned PPF, you had mentioned Employees Provident Fund, all of that.
Yeah. So that is going to continue even with the new tax structure. I feel EPF is a very good option. PPF, people who are not salaried are into that. Of course, there is ELSS, which, we try and make, you educate the crowd about that, because very honestly, very few people, when they just get into the job structure, know still about mutual fund and the equity as a investment option. There are still people who come with, real estate and having, getting into housing and things like that. Their first goal becomes that. So getting them into the education stream, about all the nuances about each of these products is still a very attractive option, because all said and done, the small savings over, the time, because of the lock-in periods, does give a good corpus at the end. So it is there from my side.
Okay. So we have 9 minutes left. What I'll do is I'll invite questions for the next 5 minutes, and then we'll go back to the panel for their closing remarks. So if you can pass the mic around, and feel free to raise your hand. Can we have the mic passed around? And it doesn't have to be a question. So if you yourself are a wealth manager or distributor, what solution are you offering to your clients? We are interested to know, how do you approach it as an investor? How do you approach your own money, your fresh money that's coming in? Are you still putting it into debt funds? Are you going for hybrid funds? Are you looking at some of the sort of high yield AIFs, MLDs?
Any questions? Yeah. Yes? All right, I'm going to come to you with the mic.
Hi, this is Lalit. I'm a distributor. I wanted to know, instead of offering any liquid products other than ultra short term and maximum to ultra short term, then going above that for the medium term bond or any other bond, don't you think asset allocator funds will do better in terms of what you get in return? Maybe 3 to 4 years of holding, and you have very less equity in that. So asset allocators will serve the purpose. Then why to have any debt product beyond ultra short-term fund with respect to the time horizon I'm talking about?
Yeah, that's a very interesting point. And we had actually done a story on this, that if you take 3-year rolling returns of hybrid funds, despite equity being in there, they tend to outperform debt funds. There is more risk, but equity does well on the long term.
Actually, Neil, what I've seen is that the understanding of asset allocation and studying correlations, that understanding is not there. See, I'll give you an example. Let us say you make there's the efficient frontier is what you're trying to find out with a risk return plot, right? So let's say if I tell you that you're holding a bond fund for 1 year, it gives you a return profile that's 7.5% average and a standard deviation of say 7. Now the question is, if I add 10% equity to this, what should happen to the risk and return? The standard answer will be, because of equity, the volatility will go up. But if you keep increasing and if you keep playing with the allocations, you will hit a certain point where the return will, per unit of risk, the return will go up. You can even have, so if you add on debt, you load on debt you load equity, and then you load gold. Basic point is you will arrive at certain allocations where the return will go up, but the risk won't go up much. I think currently that understanding of how asset allocation and how correlations work for varying combinations, that understanding is weak. So if you ask anybody, what happens if you add equity to debt? The standard answer is it becomes more risky. But no, you have to figure out at what level it works optimally.
Or at what holding period?
Which holding period and what percentage allocation it holds, it works optimally. I think that understanding needs to come about. So he's right that for so many of the time horizons, instead of debt, if you mix up asset classes, you might do better. That's one. And second is, again, I don't want to bank on tax structures to build products, but the quirk of the current taxation is that if you have 36% equity, then the balance 64% can be debt, equity, international, whatever it is, all of that comes into the lower tax slab, right? So it even furthermore makes sense to invest with these kind of asset allocated or hybrid kind of products in the current regime.
I'll just add to the point that Aashish was making that, yeah, over a long period of time, and it's advisable to have those kind of instruments. The challenge that we face is that the non-linearity of returns, right? That in the interim, sometimes you might be worse off. And if the customer or the investor exits at that point, you're doing their portfolio and your relationship with them a disservice, right? So that's the ongoing challenge that we have with multi-asset funds, where the customer is, especially if it's not been communicated correctly, they are coming in with the expectation of better than fixed income returns. But in the short term, if they lose some money, they are naturally concerned and therefore they want to exit. And they're breaking that compounding which this asset would have delivered to them.
Yeah. In fact, sorry, another question there. I'll just come to you, Deepak. But before that, I want to point out one more anomaly that's happened with this tax change on debt funds, which is that overseas feeder funds, which are taxed as debt funds, again, no matter how long you hold them, you will always be taxed at slab rate. But if you hold the same ETFs, the same stocks to LRS, you get the benefit of 20% with indexation. Again, I don't think the government had that in mind, but that has been the result of this tax change. Can we go to Deepak?
Yeah, so I have a mic. So question to Sandeep and Aashish both. Now, when he's saying that I'm putting my client's money in a short-term debt fund, the idea is allocation, that I will be needing this money anytime in the next 2, 3, 6, 8, 10 months. Adding another layer of an asset class may increase returns if he is trying to hold it beyond 3 years. No?
Only long term. Yeah.
That is the idea. So what happens is, again, these multi-asset funds are a bull market phenomenon, because you are taking the equity returns of the past 6 months, 1 year, and adding it onto those returns and showing that a multi-asset fund is a better fund. A debt fund is a debt fund. I want to preserve my capital. I am happy not paying quarterly, TDS in a bank FD. That is why I want to come into a short-term debt fund. So if that is asset allocation, then a debt fund should not be compared with a multi-asset fund. Both your views.
No, absolutely. I think the tenure has to be got right? And I think we can't see a lot of fund selection also happens on basis of recent performance or past performance, right? And I think that's where maybe allocators like us get it wrong when it's some sort of like easier way of offering products, right? When you show recent performance. I think that's definitely not the idea. And getting the tenure right is also very critical. The point I think I was making was that if the tenure is long, let's say 3 or 5 years, within that time frame, on paper, multi-asset funds likely to do better than short-term funds. The only point is that the customer or the investor should be able to live that journey, which often doesn't happen.
Also, when you're having a multi-asset or a hybrid kind of a fund, I think even the equity part can have more arbitrage in that. So it's more of a debt profile than actual long-only equity. So I think we can make products where it's debt-like, but with good taxation, and you're getting your debt-like returns.
The problem is, again, all three of you. So what happens is a customer runs away from an equity during a bad market. And if you have a product which was positioned as a debt fund which had actually equity in it, that exasperates the problem. In March 2020, if I had a debt fund which was giving me 6% returns, I would have done nothing to it. But if there was 20 or 30% equity in that, my returns could have gone to zero effectively, right?
Yeah, no, so you're right. Time horizon cannot be compromised. So that's very clear, no doubt about it.
Okay, we had a couple more questions.
Considering how nascent REITs are, any kind of I mean, any kind of time period or any kind of, specific gauges when, I mean, it becomes an asset class firstly, as you mentioned, and it achieves some kind of buoyancy or dynamism, I mean, going down the road, I mean.
See, I think that, I think it's an asset class which is less understood right now,
Right.
correct? And obviously, because it's a hybrid, it's not like, you're owning commercial property and just getting lease rental. The fact is that there is tenancy and occupancy out there. The fact is that with changes in interest rates, the expected yields will change. The fact is that underlying real estate prices could change and there could be economic cycles. So it's to be seen as a hybrid, right? And to that extent, of course, it is risky. It's not, again, that is not something which is just a direct replica for fixed income. So it needs underlying analysis, it needs advice, and you need to be in some and you may not want to be in some, right? So it needs, like a longish time frame. I would say at least 3 years to 5 years. After all the analysis, I mean,
Right.
it's a risky product.
Right.
So I don't know if everyone here is aware, but Sebi has floated a discussion paper on something called MSMRATs, medium, small, micro REITs, which will, if implemented, it will lower the minimum threshold for REITs from the current, I believe, 200 crores to 25 crores. And it doesn't say that it has to be commercial property, which opens the door to residential property. I'm very positive on this circular because, Indians, we are quite well disposed to residential property. And this was already being done in an unregulated manner through fractional investing platforms. So this will come into the light, so to speak. It will be regulated. And it will, just think of the number of new REITs that could come into the market that could transform our investing journey. Maybe we can take, okay, it says time's up. Maybe one last question and then we'll sum up.
I think what you said on REITs and the MSME REITs, and I think the beauty is that if you see from an economy or a capital market perspective, it makes your entire capital stock more productive. Because, it's more efficient usage. So I think it would have the impact of increasing productivity in the economy itself. Because there's no asset which is dead asset, that asset is again being recycled.
Yeah, fully agreed. Okay, one last question and then we'll ask the panel to sum up. All right. So if we can, go ahead, Satya.
Check. Hi, thank you so much. I'm Satya and I'm in the education space of financial education for investors. My doubt is with the debt taxation making it not so attractive for investors, will endowment plans and money back plans which are offering guaranteed returns and that too which are tax free, maturity benefits are tax free, will they come into picture again? I'm worried that comes into picture because the term cover that it offers is much, much lower than what the term cover offers. So what are your views on that?
So before he answers, so Satya is a former colleague of ours. I'm sure many of you have read her byline. She's written some of our best stories. She's now with the country's largest broker and she runs financial education for them. So Sandeep,
Yeah, I think it's, we operate in the Sebi domain. So look, I think the fact is that these have much longer tenures, right? And that's something that, as again allocators of capital who want to be able to efficiently move money around, we are not able to get our head around that. So we have not recommended these to investors for just the reason that liquidity is not easily available and I can't offer liquidity to the customer if they need money around it. I think as IRDA builds regulations around this, maybe we'll have more clarity, but I'm personally not super excited about these assets.
Vinita?
Yeah, so just adding on to the points he's already spoken about, the tenure, the lock-in period, the liquidity. We have to understand that the debt funds are there for a certain reason, that they need short term, you have certain goals and you need to liquidate them. So that, I don't think that can be taken away just because of that tax system that has come into force. It still remains, and it is still got a lot of positives, and is a product that people would be investing in. Not ULIP, no, I don't think so that's going to happen.
Yeah, I mean, God forbid that this country has to meet its fixed income needs through insurance. Probably the last thing we want. Okay, can we have a sum up, Aashish, and then we move this way?
No, I think since there are not too many questions, I think I should compliment you, right, for having like a very comprehensive discussions, So thanks a lot for having us here. I think my takeaways are only two things. I think one is that, because, I mean, ideally taxation should not be your driving force, right? You need to evaluate products on their own. And second is better understanding of how different asset classes work so that you can make the right combinations. I think these are things which are like more food for thought.
Yeah, so I think similar to Aashish is that have an asset allocation, don't think too much about taxation as such and make your decisions on that. But secondly also that one thing we didn't discuss is that debt funds are still better compared to FDs. I mean, if you're going to do like-to-like comparison, debt funds are still better than FDs, and it can be a part of people's portfolio is because it gives on-tap liquidity, they're open-ended, and taxation is on, you can defer your taxation when you sell your products. It's not like FDs, you get taxed on a yearly basis. So it's not as bad as it seems. So I think debt funds still have a place in people's portfolios.
Yeah, and there's also capital gain set off and carry forward, which you can...
Exactly.
Vinita?
Thanks for first getting us here, and then I totally agree with Mr. Anand saying that education is extremely important, and being at that root level there, we actually know that people have no idea about investments and linking it to goals and the nuances of different products. So if we do actually need to make that 10 crore to 20 crore, there is this huge gap that, we need to educate people of. I mean, we are in good times, but education is a thing that, needs to be really focused upon, and the growth needs to be there because of that.
Sandeep?
So compliments, first of all, Neil, to the team at Mint for all the work on financial education and evangelizing mutual funds especially. Two big takeaways for me: multi-asset funds have a place in the portfolio, and as allocators we should take them to clients. The second is that there is a space for accrual, high-yielding instruments on the fixed income side with the right checks and balances to ensure there's no run on the bank. But I think we as allocators, we would love to have more of those products also to be able to create multi-asset portfolios at our end.
Great. So just one takeaway that I want to emphasize as I sum up, which is that the tax system will always keep changing. It will keep throwing up surprises, more negative than positive. But we have a great industry that will come up with solutions, as they have said here. And for those of you who are in the distribution space, in the advisory space, the task then begins of communicating those solutions to your clients. So great. Thank you so much, everyone.